I was up here a year ago, and if I spoke to any of you then, I would have said to you that 2024 was going to be, excuse me, the year of a recovery for real estate. And I was wrong, because in the 12 months, things have changed a bit in the last month or so. But in the 12 months to March, we delivered a share price total return of only 1.8%. But we delivered a net asset value total return of 9.5%. So in some regards, I was right. We were delivering underlying real estate growth. It's just the shareholders didn't notice. So the investment landscape, has been difficult. There's been a real focus on the US and the Mag 7, and we've had all the geopolitical noise in the market, and an awful lot of noise comes out of the White House. Haven't worked out yet if he's got a plan. Is he cleverer than he appears? I don't know. We can talk about it over drinks afterwards. I'm sure everyone will have a view. The opportunity in fixed income has been very attractive, and real estate has had a tough time, particularly since 2022 when interest rates rose so sharply. Of course, it had a very direct impact on real estate. We saw valuations fall, and real estate just completely out of favour, and listed real estate moving to quite wide discounts to net asset value. But I think that the market is poised for a recovery. And when you look at what are the things that drive investment in real estate, here they all are in different coloured boxes to make it simple. The challenge is in the light blue. So the geopolitical, the volatility and uncertainty, it makes a lot of noise. But what's the real impact on UK domestic real estate? I would argue that actually quite a good place to hide out from a global trade war. We have properties that are domestically focused. We have tenants that have lease contracts that run out for 5 years plus, and their rents are fixed or will go upwards only. So an interesting place to hide out. But we've all been caught up in the noise. UK politics, and Thomas struggled to get the words out earlier, let's say the growth agenda has stalled. It hasn't been quite the shot in the arm that we all hoped for. So the two challenges that are perhaps harder to deal with, firstly is long-term cost of funds, the 10-year gilt rate. Short-term rates are falling. The SONIA curve has moved down, but those long-term 10-year gilt rates are staying reasonably stubbornly high at about just over 4.5%. And there is a very close correlation between listed real estate prices and 10-year gilts, the so-called risk-free rate of return. But the big challenge has been supply and demand imbalances. Because real estate has not been on particularly institutional investors' shopping lists, there has been an imbalance on the demand side, which has meant that listed real estate stocks have rated quite low. And to put that into context, and I know this is slightly mixing the stats, but in the first quarter of this year, institutional investment in direct real estate was at a 16-year low. So there must be a read across to listed real estate. It won't take much to see people swing back and look at the UK market, and once they're looking at UK market, look at UK real estate with all the volatility we're seeing from the US. So I think we could see those supply and demand imbalances change quite quickly, which is why I think we are poised for a recovery. But the reasons to be optimistic: property valuations are rising. The property market turned last summer, and we've seen valuation growth in our quarterly valuations September, December, and March, and that has principally been driven by really strong rental growth. Why are we getting rental growth? Because, and it's an old favourite, property is a good hedge against inflation. After periods of high inflation, we see rental growth. And you're seeing it really strongly. Tenants are happy to pay it. Because it's been a difficult property market for 5 years, there has been limited development, so supply is restricted, and we're seeing all that growth come through. Interest rates, the short-term rates have been falling. That's good for real estate for two reasons. Firstly, because it means those that are borrowing have cheaper costs of debt. They can afford to pay more for the property. And secondly, for a listed business like us, reducing our variable rate costs of debt gives us a little bit more earnings headroom to pay our fully covered and sustainable dividends. There has been a lot of corporate activity in the investment trust sector across the board, but particularly in real estate. What's interesting about it is, if you look at the average discount to net asset value of the entire listed real estate world, it's at about 23% discount. Yet all the M&A activity, either take privates or mergers, the deals have been done at somewhere between net asset value and a 10% discount, not at 23. So the market's pricing listed real estate at a 23 discount, but those that are actively investing in the market are saying, come on, somewhere closer to net asset value is closer to the real value. So I think these wide discounts are going to narrow. But what it has meant is there's been a really good opportunity to get invested with very high dividend yields. This chart just looks at the 10-year gilt rate charted against the FTSE EPRA UK REIT index, which is basically the listed real estate universe in the UK. I can tell you what all the letters stand for afterwards. And you can see that there's a near perfect correlation. Now, the hope is we will see a fall in the 10-year gilt, and that will then see an upswing in property prices. But of course, we've also got the demand-supply imbalance that will swing, and the SONIA short-term rates. You know what that looks like, but you can see, and that's changing all the time. So let's not dwell on that for too long. This is perhaps a more interesting chart. This is the Investment Property Forum's consensus forecast of total returns from UK real estate. Who are the Investment Property Forum? They're the great and the good of real estate. Advisors, banks, institutional investors, and they all, on a quarterly basis, contribute to a consensus forecast of what they think returns from real estate are going to be. It's broken down by sector. These are the all property numbers, and you can see really strongly positive total returns from real estate, over 8% for the next 3 years. And the notable feature is the strong and recurring income, and that's what and Thomas was talking about income at the start, and I was sitting there just nodding along thinking, yeah, but this is absolutely right. It's all about income, and that's what we do. If you were to break down the all property returns and look at some of the sector returns, what will you see? You'll see that industrial and logistics property is still the poster boy for rental growth. That is still, we're seeing the most rental growth. For retail warehousing, out-of-town retail parks, that's where we're likely to see the greatest total return, so strong capital growth recovery and some rental growth. But we are also seeing rental growth in offices and rental growth on the high street. So this is the first time for quite a few years now when all the sectors are heading in the right direction. So that's the big picture, a little bit more about us. I took to AI to answer this question because I've been saying for 11 years why people should invest in Custodian Property Income REIT. So I asked ChatGPT what it thought. And I was pleased to say that it came up with a pretty decent set of reasons. I didn't put the professional management in. That was very kind of someone in AI to put that in. But I'm pleased that they think it's professionally managed. But the important thing about Custodian, it's a diversified portfolio. It's diversified to mitigate risk. It is liquid because it's a listed fund. It's tax efficient as a real estate investment trust. There is no tax in the corporate vehicle. The tax is paid by shareholders on their dividends. And importantly, on the left-hand side of the chart, stable income stream, that hedge against inflation that we're really seeing at the moment, and the very attractive yield that you can get. Now, our share price has been moving quite a bit over the last few weeks, from early 70s pence per share to about 84 pence today. So that's about a 7.25% dividend yield today, but really very attractive income. We do things a little bit differently to others, and I know all investment managers say that, but we all operate in the same market. But what we do is try and highlight the opportunity, particularly in regional markets, smaller assets, where we think we can get a good pickup in income return. We've got 150 properties in about 600 million, so an average lot size of around 4 million, over 300 tenancies, and that supports a fully covered 6 pence per share dividend, and at the time of writing this, that was giving you a 7.9% yield. So I'm sorry that I didn't get around to seeing you all sooner, because it's 7.25 today. And the portfolio is delivering really strong rental growth. The passing rent of the portfolio, 44 million. The ERV, the estimated rental value of the portfolio, is 50 million. So that's a 14% reversionary potential. And when we look at what we delivered in the last 3 months, this is the quarter to March, so not quite the last 3 months, but you know what I mean, you can see really strong numbers across the board. Like-for-like valuation growth, 1.5%, so that's 2.4% annually. Rental growth of 1.5%, matching that valuation growth. That's important because that is sustainable growth. It's growth based on higher rents rather than just on hardening yields. And that rental growth has delivered 5.5% annually. In the quarter, 17 new lettings. Post-period end, in the last couple of months, we have delivered 3 more new lettings. And you can see long leases, strong rental growth, Romac and DHL. Romac is just at Eurocentral, which is just to the east of Glasgow. DHL is at Speke, which is by John Lennon Airport in the northwest. And even in the office market, this building you can see here, we refurbished. It's in central Manchester. Rents were £20 a square foot. We let the first floor of that refurbished space at £36 a square foot. That's an 80% increase in rent. One of the numbers that I'll just pull out in the rental growth box is that we did 9 renewals and got a 13% increase in the rent. But interestingly, the rents we agreed were 11% ahead of our valuer's estimate of rental value. And that's not because the valuers got it wrong, it's because they were looking back at deals that have been done, and in a growing market, we're setting rents based on where we think rents will go. So we'll probably beat that 14% reversion. And we also garnered additional income from the sun and took £100,000 worth of income from 10 solar arrays that we put on our buildings, where we sell the electricity to our tenants. They get a discount against the market rate, and that was just from 10 schemes. We've got another 12 projects underway at the moment. So an interesting source of additional income from real estate, from assets that we already own. And all of that has led to a positive quarterly NAV total return of 3.5%. Just at the beginning of this week, we announced an all-share corporate acquisition. We acquired a family property company called Merlin. It's only a small deal, £22 million, but we paid for that with our shares, so no cash changed hands. They have become a substantial shareholder now in Custodian Property Income REIT. Their portfolio was ungeared, so has brought our gearing down from 27 to 25%. So it was a really good deal for us, and the average portfolio yield was 8.1%, so accretive to earnings. It was also a really interesting deal for the family, who had a succession challenge. 3 brothers had set it up. The next generation didn't want to run the company, and there were lots of them. So by converting their property portfolio into Custodian REIT stock, they've got something that is liquid, divisible. They were able to roll the gain into their Custodian REIT stock, so no CGT on the transaction. And actually, it enhanced the income to the family as well. So a really interesting deal to do in a market where growth is difficult. So this chart looking at rental growth, I've sort of talked about it already. What you can see is that light blue line is that reversionary potential, and you can see how that rental growth really started to build in from 2020, and then the dark blue bars are the rent roll of the portfolio. The keen-eyed among you will see that it dropped on the for March 25. That was just an accident of timing. We had 3 leases that expired, and 2 of those that we talked about before were to Romac and DHL. So post-period end, we have actually got the rent roll back up to where it was, and indeed recovered the occupancy back to 93%. But good numbers across the board. When we talk about smaller regional property, I think sometimes we have to explain what we mean, and the best way to do that is with pictures. What we're not talking about is workshops under the arches or corner shops. We're talking about mainstream commercial property, but it is typically considered too small for institutional investors, and that allows us to get a higher marginal income. The portfolio is weighted to industrial, logistics, and retail warehousing, weighted to those sectors because that's where we believe there'll be the most rental growth. And we constantly comb through the portfolio, and every property has to justify itself on a quarterly basis. We sold at just a month ago 2 out-of-town office buildings in South Manchester because we felt they no longer justified a place in the portfolio. We couldn't see where the rental growth was going to come from. We sold them at a premium to valuation, but it is a constant process of combing through what is a very diverse portfolio, and you can see the dots on the map. And what we're trying to find is those commercial hotspots in regional markets. And when we're talking about diversification, I think this chart says it all. This pie chart shows the amount of income that's paid by any single tenant in the portfolio, and we have no one property let to any single tenant that represents more than 1.5% of our total rent roll. And even amongst our largest tenants, there is further diversification because take Menzies distribution, and yes, they do call themselves Menzies, before I'm corrected. We've got 8 properties let to them, so there is further diversification both by building and geography in those larger slices of the pie. And one of the other challenges that sometimes is laid at our door is, well, surely if you're buying all these small properties, you must have sort of rubbish tenants and lots of tenant risk. Not so. I'm pleased to report this is the Experian credit rating of the tenants in our portfolio, and you can see that 84% are considered lower than average risk by Experian. So in summary, we have good quality income, broadly diversified in a modern portfolio of well-located properties with rental growth, yet we are still trading at a discount that affords incoming investors a 7.25% dividend yield. That feels to me like a very good entry point in a recovering market. Our dividend history is there for you to see. Dark blue line, the dividends, light blue is earnings, so always paid out of earnings. We think that's important, that we live within our means and pay a covered dividend. The question you would rightly ask is what happened in 2020-21? Well, of course, we all know what happened. One of the first things the government did in COVID was said if you don't have to pay your rent as a tenant in the given year. You won't let off your rent, but you could defer it if you wanted to. So we didn't know whether we were going to collect rent or not. We didn't know how long it was going to go on for. So rather than paying our dividends out of earnings, we adjusted to paying it out of cash rents collected. Turned out we collected 92% of the rent in that year. So tenants were really supportive. And we expected we would grow the dividend back post-COVID. But of course, come 2022, we saw interest rates go up. That's a very real cost for a real estate business, and that squeezed earnings a bit. But nevertheless, we have managed to grow the dividend from 5p per share in 2021 to 6p per share today. So why do we do what we do? I've got 1 minute. Actually, I've got 30 minutes and 1 minute because the other speaker isn't here. So I'm going to enjoy myself, if you'll forgive me. This explains why we do what we do. Why do we buy those smaller properties? And what this chart looks at is the net initial yield of properties that have traded in the market with a lot size of under 10 million, that's the dark blue line, versus lots of over 10 million, the light blue line. And you can see there was a pretty narrow and consistent margin in the first 10 years of about 65 basis points. And back then, all investors would buy all lot size. It was just about quality of location, quality of building, quality of income. But post-2010, lot size became a real thing. Most institutional investors particularly wanted lot sizes of 10 to 15 million pounds plus. And what you're seeing is not a change in risk profile that saw that divergence between the small and large lot size, but a change in supply and demand dynamics. Fewer people buying the smaller ones, more people buying the larger ones. And that has opened up, over most of that period, a 140, 150 basis point margin. Now, it's narrowed a little bit, you can see on the right-hand side, in the last year, but actually that is quite stock-specific. There have, in the year to date, been quite a number of large assets sold for very high yields, but they've been shopping centres and they've been offices. So that skewed the numbers a bit. But broadly, there still remains a good 100 basis point margin. And that, of course, supports a higher dividend yield, and we would argue without taking additional risk. And that higher margin also means that we have maintained a healthier buffer over our variable cost of debt, and that's what this chart is showing. In the grey, our cost of debt, which is 3.9% today, weighted average cost of debt, versus our portfolio yield, which is the light blue, and then the reversionary potential on top as we pick up rent reviews and lease renewals and pick up that rental growth. So there's a very healthy margin over the cost of debt. And because of our strategy that targets that higher yield, we've been much more resilient to the increase in cost of debt than some other funds. This looks at relative performance. I'm well into the questions now, so I think I should stop. But I perhaps will stop here and say, look, I'm not particularly impressed by that total return chart with a dark blue line. The grey line at the bottom is the Natalie named FTSE EPRA UK NAREIT index, so it's the whole of the listed sector. I'm not particularly impressed, but this is to the bottom of a market cycle. So positive returns, but to the bottom of a cycle. But we've outperformed the index because each and every year we've paid a higher dividend. And it's that recurring dividend income component of total return that has led to that outperformance. So I've said enough. You must read that. And any questions?
Thank you, Richard. Any questions? Oh, we've got a couple.
Yeah, you said your occupancy rate is 93%. What is your target rate? Would that be expected to stay at that rate?
I think anything over 95% would be unlikely, just because leases typically are for 5 years. When they come to an end, a percentage of tenants won't renew. Actually, it's when you get the properties back as a landlord that you get the chance to invest in them and improve their environmental credentials, bring them up to current standards to get the best possible rents. So I would have thought somewhere between 90 and 95% is a realistic long-term average.
And you said you're putting solar panels in some of the buildings. How many more buildings would be suitable for that?
I think we reckon there are about 90 that would be suitable. And we've done 10, got another 12, so we are, getting on for a quarter of the way there.
And there's been some takeover, I think it's the warehouse rate or something. We're going to be takeover. Are you a possible target for a takeover?
I haven't had any approaches so far. We ask ourselves that question all the time. I think because our strategy is somewhat different, I think we feel like a bit of a challenging takeover. What people are looking for is a small number of large assets, easy to manage. We've got a team of 7 surveyors managing these 150 properties that are spread, as you saw, across the UK. And I don't think it doesn't appear to be very appealing. But I think they're missing an opportunity in a sector of the market that we really like.
Question over there, please.
Hi, thanks for the presentation. I got one question. At the very beginning of your presentation, you mentioned that short-term interest rate has dropped, which is like good news for us. But you didn't mention the long-term interest rate, which I think is more related to the mortgage. So
Yeah.
how do you think this would affect your portfolio and the strategy, or does it affect at all?
Yeah, well, I mean, you're absolutely right that the long-term rate is remaining stubbornly high. So I don't think we're not going to see a whole-scale re-rating of listed real estate. I think, and I hope some of the numbers, if you finish reading that, I'll move it back. But if you think back to some of the numbers around growth, is this the right slide? Yes, it is. So 5.5% annual growth rate. That is what's going to lead to the growth with long-term rates staying where they are. Because of our higher income-focused strategy, I think we are better able to operate in a higher interest rate environment. But let's just frame what we mean by a higher interest rate environment. Before I was a property fund manager, I was a property investment agent. And we were pretty much doing cartwheels around the office when interest rates hit 5%. We thought money could never get cheaper. This is absolutely fantastic. And then we had 15 years of near zero interest rates. So I think if we've got interest rates somewhere between 4% and 5%, we can run an extremely effective property investment strategy, particularly with income returns where they are and with rental growth. The short-term rates, yes, they do give us a little bit more of earnings headroom today. But I think you're right. I think the long-term rates will stay higher. And probably they should. And we shouldn't be wishing for really low interest rates because it means there's something wrong with the economy.
Richard, you mentioned that for once all the sectors are in growth. Are there any particular parts of the UK where you're seeing that sort of recovery in the retail and some of the lower growth areas historically?
There isn't a region that is particularly outperforming, but within every region there are subsectors. So in cities, because let's take offices, because no one wants to invest in offices, obviously. Or do they? Actually, it could be one of the best performing sectors in the next phase of the cycle. We've now got office rents hitting £50 a square foot in sort of big six regional cities, so Edinburgh, Manchester, probably Glasgow, Bristol, Leeds. Really strong rental growth that's come through on the high street. It is, and let's take a very local example. We own a shop on George Street, and I would much sooner own on George Street than on Princes Street. But if you go back 20 years, Princes Street is where you would own. That's where all the institutional investment was focused, because that was the style of retailing that was doing well at the time. And now that sort of style of retailing is very different. Retailing is about having a day out in a nice environment, not slogging down Princes Street past the many charming shops and many fewer less charming shops, perhaps. But so it's changing. So we like sort of cathedral cities, university cities, high tourist footfall. In those locations, we will see retail rents growing this year.
Okay.
So, but it's micro locations, not macro.
Sure. Are there any more questions? Oh, there's one here.
Can I ask him, just on that
Just
point?
hang on, sir. Hang on.
Oh, yeah. I can speak later. I was just going to ask you, all the coffee shops in the UK, do you own leasehold in a lot of those places?
We do have a number of coffee shops. In fact, probably 5 years ago, we actively tried to increase our exposure, particularly to drive-through coffee shops. And just by way of example, we had a Pizza Hut in Watford, it's very salubrious, and Pizza Hut put themselves through a CVA. And as part of it, so company voluntary arrangement, so they were saying, we're not going to pay any rent to our landlords, and you've got to let us off all the responsibilities under the lease. And one of the opportunities that you have as a landlord in that situation is to break the lease. And almost out of principle, we break the lease with tenants that push us into CVA, because they're effectively, they are prejudicing us as landlords versus the other creditors of the business, and I don't like that. So we kicked them out, and we added a drive-through lane to what had been a drive-to pizza. Restaurant sounds wrong, doesn't it? Shop, maybe. I think they'd call themselves a pizza restaurant. So we then had a drive-through facility, and we put it on the market, and we had 19 occupiers who wanted to take the lease, one of whom, bizarrely, was Pizza Hut themselves. Finally, they didn't make it to the top of the list, and we let that to a coffee shop. But really strong demand. And when we did that, rents were probably £28, £30 a square foot for drive-through coffee shops. They're now 60. So there's been really strong rental growth. And, I'm sure we've all experienced it. Wherever you go in the country, if you go into a coffee shop at any time of the day, they're always busy.
Good point. Can I just ask a question, Richard? You mentioned about the lettings being recurring revenue. Is that fair to say? So how much does that account for your overall revenue?
Well, all our revenue is rental income, with the exception of £500,000 worth of solar PV income.
Right, okay.
No, we are a real estate investment trust, so that's what we do. And on average, it's 5 years contractual income. Mm-hmm. But we're not worried about leases coming to an end. That's just part of managing a real estate portfolio. Actually, it's normally when you get the chance to push the rents on.
And you also mentioned the fact that you've got strong retail growth in office rents.
Yeah.
So the culture of working from home is gone?
Do you know, there was some statistics out at the start of the year, and I will misquote them because I don't remember them verbatim. But it basically said that there is no discernible impact on the office market of working from home. And most people who work in offices are going in a minimum of 3 days a week. But if you're going in 3 days a week or 5 days a week, you still need an office. Yeah. And people who are running businesses know only too well there's a real competitive advantage of getting your team together, getting them in the office. What's changed is, from a landlord's perspective, you've got to make offices that are attractive places to come to work. You can't just have a big empty room with rows of desks. If office buildings aren't appealing places to come to work, people won't turn up. So in many ways, it's created an opportunity for differentiation between, so the building we've got in Manchester, it is, one of my team did it, so I can say about it, it's a fabulous building now, but it was a bit dull before, and the rents reflect that.
Okay, thank you very much. Thank you.
Thank you, everyone. Thank you, Richard.